Preparing for a financial analyst at Co-op interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Tell me about yourself and why you want to become a financial analyst at Co-op. I am an analytically minded candidate with experience turning financial data into practical recommendations. Through my studies and previous projects, I developed strong Excel, budgeting, variance analysis, and presentation skills. Co-op interests me because its cooperative model connects commercial performance with member value and responsible business decisions. I would enjoy partnering with operational teams, understanding what drives sales and margins, and producing clear analysis that helps management allocate resources and improve long-term performance. While answering, focus on your analytical training, commercial curiosity, Excel or data skills, interest in retail or cooperative businesses, and how your experience can improve decisions, profitability, forecasting, and member value. Question 2. What do you understand about Coop's business model? Co-op operates as a retail business while also serving members who have a stake in its cooperative structure. Its financial performance depends on sales volumes, pricing, product mix, gross margins, inventory availability, labor costs, and disciplined operating expenses. The cooperative model adds an important perspective. Decisions should support sustainable profitability and customer value, not simply short-term earnings. A financial analyst therefore needs to connect financial results with store operations, member behavior, and competitive market conditions. Make sure to cover Coop's cooperative ownership structure, retail operations, customer and member focus, revenue and margin drivers, scale benefits, competitive pressures, and why financial analysis must balance profitability with long-term member value. Question 3. How would you build an annual budget for a co-op retail division? I would begin with historical performance, separating recurring trends from one-off items. Then I would build sales assumptions by store, category, volume, price, promotions, and seasonality. I would model gross margin, payroll, rent, logistics, utilities, marketing, capital spending, and working capital separately. After reviewing assumptions with commercial and operational managers, I would prepare base, upside, and downside cases. Once approved, I would create a monthly tracking process linking actual results to budget and explaining deviations. In your answer, talk about historical actuals, store-level assumptions, sales drivers, seasonality, margins, labor, rent, logistics, capital expenditure, stakeholder challenge, scenario analysis, and monthly monitoring against approved targets. Question 4. How do you perform a meaningful budget versus actual variance analysis? I first calculate the absolute and percentage variance, then prioritize items based on materiality and business impact. For sales, I separate volume, price, and mix effects. For costs, I distinguish rate, usage, timing, and one-off variances. I would speak with budget owners to validate the operational cause, not assume the ledger explains everything. Finally, I would summarize the financial impact, whether it is temporary or structural, and the action needed to protect the forecast. Be sure to mention materiality, favorable versus unfavorable classification, price-volume mix analysis, timing and one-off effects, root cause investigation, management implications, and recommended corrective actions rather than merely reporting numerical differences. Question 5. Which key performance indicators would you monitor for Co-op? I would monitor like-for-like sales, transaction count, average basket size, gross margin, promotional effectiveness, shrinkage, inventory turnover, availability, labor cost per sales unit, operating expense ratios, and cash conversion. I would also consider customer satisfaction and membership engagement because they influence future revenue and loyalty. The important point is not to create a long dashboard. Each KPI should have an owner, a target, a clear definition, and a connection to an operational decision. Focus on revenue growth, like-for-like sales, transaction volumes, basket size, gross margin, shrinkage, inventory turns, labor productivity, operating expenses, cash conversion, customer metrics, and how each KPI supports a management decision. Question 6. How would you forecast sales for a co-op store or product category? I would establish a historical baseline and adjust it for seasonality, holidays, pricing, promotions, store openings, local conditions, and competitive activity. For a category, I would also examine volume, average selling price, product mix, and cannibalization between products. I would compare a statistical forecast with commercial managers' knowledge, challenge unsupported assumptions, and document the bridge from prior forecast to current forecast. Monthly reforecasting would keep the model responsive without creating unnecessary noise. While answering, cover historical run rates, seasonality, price changes, promotions, holidays, store openings, competition, weather or local effects, management input, statistical checks, and regular forecast revisions using the latest actual performance. Question 7. What is the difference between gross margin, operating margin, and EBITDA margin? Gross margin equals sales minus cost of goods sold, divided by sales, so it reflects pricing, purchasing, and product mix. Operating margin deducts operating expenses and depreciation, showing profitability after running the business and using its assets. EBITDA margin adds back depreciation and amortization, providing a view before non-cash asset charges, although it is not cash flow. In retail, tracking all three helps distinguish merchandise economics from store productivity and investment intensity. Make sure to define each margin clearly, explain the relevant income statement costs, distinguish operating performance from depreciation and financing effects, and relate the measures to Coop's pricing, product mix, store costs, and investment decisions. Question 8. How would you investigate a decline in gross margin at Co-op? I would first confirm the calculation and compare the decline by store, category, supplier, and period. Then I would separate price, volume, and mix effects, investigate promotions and markdowns, and review supplier cost increases, purchase terms, shrinkage, write-downs, and foreign exchange exposure. I would discuss operational explanations with buying and store teams, then quantify each driver. The conclusion should identify whether the pressure is temporary, controllable, or structural, with specific margin recovery actions. In your answer, talk about price changes, supplier costs, product mix, promotions, markdowns, shrinkage, inventory adjustments, foreign exchange, purchase terms, data validation, and separating temporary pressure from a structural profitability issue. Question 9. Explain how working capital affects Coop's cash flow. Working capital determines how much cash is tied up in day-to-day operations. For Co-op, inventory is usually the largest operational driver, while supplier payment terms can provide financing. Higher inventory or slower turnover consumes cash. Longer payables generally release cash, although supplier relationships must be protected. Receivables may matter less in some retail channels but still require monitoring. I would track the cash conversion cycle alongside service levels, because reducing stock too aggressively can damage availability and sales. Be sure to mention inventory, trade payables, receivables, the cash conversion cycle, seasonal purchasing, supplier terms, stock availability, liquidity trade-offs, and why accounting profit does not automatically equal cash generation. Question 10. How would you analyze inventory performance and recommend improvements? I would analyze inventory by category and location using turnover, days on hand, sell-through, availability, aging, markdowns, and write-offs. I would identify whether excess stock reflects weak demand forecasts, ordering policies, slow suppliers, or poor product mix. Recommendations might include improved replenishment parameters, targeted promotions, supplier changes, or tighter safety stock rules. I would avoid optimizing cash at the expense of availability, so I would assess sales lost from stockouts before proposing aggressive reductions. Focus on inventory turnover, days inventory outstanding, sell-through, stock availability, aging, obsolete goods, forecast accuracy, replenishment, safety stock, markdowns, and the balance between cash efficiency and customer service. Question 11. Describe an Excel model you would build for financial planning. I would build a driver-based planning model with separate tabs for inputs, operational assumptions, calculations, outputs, and checks. Store sales would be driven by transactions and average basket size, while costs would link to volume, headcount, rates, or fixed assumptions. I would include scenario switches, reconciliation checks, clear formatting, and documentation. Before sharing it, I would test extreme cases, compare outputs with historical results, and protect key formulas from accidental changes. While answering, cover clear inputs, assumptions, calculations, outputs, checks, modular structure, formulas, scenario controls, documentation, version control, error prevention, and how the model would support forecasting or decision-making. Question 12. What Excel functions and tools are most useful to a financial analyst? I frequently use Excel OOKUP, SUMIFs, if statements, date functions, pivot tables, charts, and conditional formatting. For larger recurring data sets, Power Query can automate cleaning and reduce manual errors. I also use data validation and reconciliation checks to make models safer. My approach is to keep formulas readable, separate inputs from calculations, and avoid unnecessary hardcoding. Advanced tools are valuable only when they make the analysis faster, more reliable, and easier for others to review. In your answer, mention Excel OOKUP or index match, SUMIFs, if logic, pivot tables, Power Query, charts, data validation, conditional formatting, error checks, and the importance of transparent, auditable spreadsheet construction. Question 13. How would you evaluate whether a promotion was financially successful? I would compare promoted performance with a credible baseline, ideally using similar stores, products, or prior periods. I would measure incremental units and revenue, but also calculate gross profit after discounts, supplier funding, markdowns, and cannibalization. I would check whether customers bought forward or whether sales simply shifted between products or weeks. Finally, I would consider traffic, new customer acquisition, and post-promotion retention, then recommend repeating, redesigning, or discontinuing the promotion. Make sure to cover incremental sales, baseline demand, gross margin, discount cost, cannibalization, forward buying, supplier funding, traffic, customer retention, post-promotion effects, and return on promotional investment. Question 14. Tell me about a time you found an error in financial data. In a university project, I noticed that a monthly expense trend suddenly doubled despite stable activity. I reconciled the source file to the general ledger and found that one cost category had been imported twice. I documented the issue, corrected the dataset, and explained the impact to the team before updating the analysis. I then added a duplicate record check and a control total to the process. That experience reinforced the importance of questioning unusual movements rather than accepting outputs automatically. Be sure to mention the initial warning sign, validation procedures, root cause analysis, communication style, correction, control improvement, and measurable impact, using a concise star structure without blaming colleagues. Question 15. How would you explain a complex financial issue to a non-finance manager? I would start with the business message rather than the accounting terminology. What changed, why it matters, and what decision is required. I would use a simple bridge or chart to show the main drivers, quantify the impact, and separate facts from assumptions. For example, instead of saying margin declined because of mix variance, I would explain that customers shifted toward lower margin products. I would finish with practical options, trade-offs, and a clear recommendation. Focus on starting with the decision required, using plain language, quantifying the business impact, visualizing key drivers, avoiding unnecessary technical detail, checking understanding, and offering practical actions with clear ownership. Question 16. How do accounting principles affect a financial analyst's work? Accounting principles ensure that reported results reflect the period and activity they relate to. I need to understand accruals, cut-off, depreciation, leases, provisions, inventory valuation, and impairments so I do not confuse timing effects with genuine operational changes. For example, an unpaid supplier invoice still belongs in expenses when the goods were received. Strong accounting knowledge helps me reconcile management reports to statutory numbers and produce forecasts that are economically meaningful, not just arithmetically correct. In your answer, discuss accrual accounting, matching, cut-off, depreciation, provisions, leases, inventory valuation, consistency, management reporting, and why understanding accounting prevents misleading analysis of operational performance. Question 17. What would you do if a senior stakeholder challenged your forecast assumptions? I would first understand which assumption they challenge and why, rather than defending the model reflexively. I would review the supporting data, compare it with operational evidence, and test an alternative scenario if appropriate. If their information is credible, I would update the forecast and document the change. If not, I would explain the evidence and show the financial consequence transparently. The goal is a better forecast, not winning an argument. I would agree on ownership and review timing. While answering, cover listening carefully, distinguishing evidence from judgment, asking for operational support, testing alternative cases, remaining objective, documenting assumptions, and escalating only when necessary while preserving a constructive relationship. Question 18. How would you assess a proposed new co-op store or major capital investment? I would build incremental cash flows, including sales, gross margin, staffing, rent, utilities, logistics, marketing, taxes, working capital, and capital expenditure. I would consider cannibalization of nearby stores and model ramp up over time rather than assuming immediate maturity. I would evaluate NPV, IRR, payback, and sensitivities around sales, margin, and construction cost. Beyond the financial case, I would assess strategic fit and execution risk, then define post-investment KPIs to test whether the assumptions were achieved. Make sure to cover incremental sales, cannibalization, capital expenditure, operating costs, working capital, cash flows, payback, NPV, IRR, sensitivity analysis, strategic benefits, execution risks, and post-investment performance tracking. Question 19. How do you prioritize when several managers request urgent analysis? I would quickly clarify the decision each request supports, the true deadline, the financial impact, and whether another deliverable depends on it. I would prioritize regulatory, cash, and high-value decisions first, then estimate the effort and data needed. I would communicate trade-offs early instead of silently missing deadlines. Where appropriate, I would provide a reliable first view with key assumptions, then refine it later. I would maintain quality through documented checks, even when timing is tight. Be sure to mention business impact, deadline, decision dependency, effort required, data availability, stakeholder communication, minimum viable analysis, reprioritization, and maintaining quality and confidentiality under pressure. Question 20. What would you do in your first 90 days as a financial analyst at Coop? During the first month, I would learn Coop's strategy, reporting calendar, systems, KPI definitions, and key commercial drivers while meeting finance and operational stakeholders. In the second month, I would reproduce core reports, validate data flows, and identify recurring manual effort or control gaps. By the third month, I would deliver a practical improvement, such as a clearer variance dashboard or automated data step. I would prioritize accuracy and stakeholder trust, then build a roadmap for broader enhancements. In your answer, Cover learning the business and reporting calendar, understanding data sources, meeting stakeholders, validating definitions, identifying quick wins, improving controls, delivering useful analysis, and building trust before making major process changes. If you are still with us, congratulations! You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.